Okay, ji, let's start the question. Discuss the agency problems created by Joshua proposed takeover of Fraser Company as a defense and risk diversification strategy and explain how these could be mitigated. Okay. Prepare a report for the board of directors of Joshua Company that calculate the post-acquisition weighted average cost of capital. Estimate the additional value to shareholder from Joshua Company proposed acquisition of Fraser. Compare shareholder wealth before and after the acquisition by calculating the percentage change in equity value and next year dividend income for both companies. Advise the board of any concern either company shareholder may have with the acquisition and discuss the validity of the assumption made in evaluating the proposal in part B 1, 2, and 3. Discuss the credibility of the CEO alternative suggestion to use a share buyback as a takeover defense. Advise whether or not this is a feasible strategy. Professional marks will be awarded for the demonstration of skill in communication, analysis, skepticism, and commercial acumen. Okay, that's the question. Joshua Company is a listed leading fashion retailer with stores based in flagship retail store centers nationwide. Joshua Company is a listed leading fashion retailer with stores based in flagship retail centers nationwide. For many years, Joshua has been highly popular, but its financial performance has suffered recently due to problems associated with its online operation. These problems are causing concern for the company institutional shareholders. Online rivals have emerged in recent years and are quickly reducing Joshua market shares. These companies have also successfully diversified into other areas such as household furnishing once they have established a well-known brand. Joshua recently attempted to acquire one of these online rivals, Fraser Company, but neither company shareholder approved the deal on the grounds that it was unlikely to create value. Following a series of profit warnings, there has been ongoing media speculation that Joshua Company is attracting takeover interest. There has been no approach made so far, but Joshua Company directors are concerned about the implication for their future in the company. Joshua Company chairman would like to discuss defense strategy at an upcoming board meeting, particularly the suggestion that company could defend itself against a takeover by improving its own takeover offer for Fraser Company. The rationale for this suggestion is that it would be much more difficult to acquire a large company. In addition, this would also introduce a risk diversification benefit into a Joshua company operations. Okay. Joshua funding option have deteriorated significantly since last year cash offer for Fraser Company was rejected. It no longer has a cash reserve required to fund another cash offer, and the shareholders are unlikely to agree to a right issue so soon after the last attempt, which also ended in failure. In addition, Joshua Company gearing significantly exceeds the industry average, and the company is close to breaching one of its bank covenants. CEO has therefore suggested a new offer is made for Fraser Company based on share for share exchange. Market value of equity of Joshua and Fraser is given, asset beta is given, dividends are given, ordinary shares are given. Okay, ji. Joshua cost of capital. Joshua post-acquisition asset beta can be assumed to be weighted average of both companies' pre-acquisition asset betas, weighted in the proportion of their market value of equity. The board intends to maintain the company existing debt equity ratio of 30-70 based on market value, and they expect the pre-tax credit spread on the Joshua debt to remain at 4.1% above the risk-free rate if the Fraser is acquired. Post-acquisition cash flow, according to the finance director forecast, Joshua will earn profit before interest and tax 27.2 in the first year, growing by 5%. It is assumed that tax allowable depreciation will be equivalent to the amount of investment needed to maintain existing operation. However, investment in assets of 2.7 million will be required in year 1 and then 2.13 per $1 increase in PBIT from year 2 onwards. It is expected that acquisition will create after-tax synergies worth 9.2 million per year in each of the first 2 years. From year 5 onwards, the company free cash flows are expected to grow annually by 3%. The CEO proposal for a share for share exchange will involve one Fraser company share being exchanged for three Joshua company shares. Based on last year's negotiation, the board believes it has a good understanding of Fraser company expectation. You have therefore been asked to incorporate a minimum acquisition premium of 35% in your analysis, which is the same premium which was requested last year. Fraser founder and majority shareholder is unlikely to approve an acquisition offer on terms which would lead to a reduction in the annual dividend. However, Joshua company debt includes a covenant restricted dividend payment to 25% on each year free cash flow to the firm. The board has therefore also asked for an evaluation of the impact of the proposed term on the next year forecast post-acquisition dividend for both companies. Risk-free rate is 3.7, market risk premium is 8.1%, tax is 80. Share buyback. As yet, there have been no formal takeover offer for Joshua. However, the board wants to be fully prepared in case this changes, particularly if their own takeover of Fraser is not viable. The director have been attending a series of seminars on alternative takeover defenses and would like to discuss their finding at the next board meeting. The topic to be discussed include the possibility of using a share buyback as a defense. This would involve Joshua company buying and then cancelling some of its own share. Company CEO has asked for advice on the credibility of such a defense and would like to discuss the effect on the company EPS, cost of capital and share price. In the context of the company liquidity problem and a further bank covenant which has imposed a restriction on what assets can be disposed. So we have to discuss it as well. So let's start the requirements one by one. Okay, guys, let's solve this question. Okay, obviously it's a big question and there are many subjective information is given. So the idea is before solving any numerical, let's solve the theory. Before solving any theory, let's solve the numerical. So please read the requirement. B part. Calculate the post-acquisition weighted average cost of capital. Open the spreadsheet. Post-acquisition weighted average cost of capital. Give the heading. Part B. First. Now, Appendix 1. Appendix 1. That is post-acquisition weighted average cost of capital. Post-acquisition weighted average cost of capital. Okay. Now let's start. Read it again and then we will solve it. What happened is I think I have started the vice option. Let me please open the exhibit 2. Okay. Asset beta of both companies are given 0.85 and 1.8. The post-acquisition asset beta can be assumed to be weighted average of both companies' individual asset betas. So let me write the acquirer name. Joshua asset beta. That is 0.85. Fraser asset beta. That is 1.18. And both will be averaged using their individual market values. Market values are also given. Sure, market value. Dollars. One or two. Fraser market value. That is 56. So weighted average beta. That is, calculate the total of these two. 0.85 into this divided by total plus 1.18 into this divided by total. 0.97. Okay. And the gearing is 30:70. So that is 30 equity /70. Asset into market value of equity plus debt into 1 minus T 0.82 divided by equity 1.31 beta equity. Okay, the first step is calculating weighted average beta asset. Calculating weighted average beta asset. Second step is re-gear beta asset using group gearing. Using post acquisition gearing. So beta equity is 1.31. Why we are re-gearing the beta? Because we can only use beta equity in the CAPM. We cannot use beta asset except APV. याद आया? हाँ जी, that's the reason. So now let's calculate the calculating KE. Okay, risk-free rate is given 3.7%. Market risk premium is given 8.1%. So KE is risk-free rate plus beta into market risk premium 14.28%. Now calculating the KD. Risk-free rate is 3.7. Spread is 4.1%. Remember, spread is 4.1%. It is written here. 410 basis. So KD is risk-free rate plus spread into 1 minus T, 0.82, because tax is 18%. .4% is the KD. Now calculate the WACC. Calculating WACC. Debt and equity is 30 and 70. Cost of equity is, cost of debt is 6.4. Cost of equity is 14.28. So let's calculate the WACC. 11.92%. That is WACC. That's how you will calculate the WACC. So we are done with part A. Part B is estimate the additional value to shareholder from Joshua proposed acquisition of Fraser. So part B, second, appendix 2. We need to calculate the additional value. Okay, post acquisition cash flows. Combined value. Yes, it's a combined value. Post acquisition let's round off the million. Years. Four. PBIT is given. And year 1 PBIT is 27.2 million. And it will grow by 5% in each year. PBIT will grow by 5% in each year. Into 5%. Remember the formula of free cash flows, PBIT, then apply the tax, 18%. Then add back the depreciation, but depreciation and capex are same. So additional capex. That is 2.7 million. Then 2.13 per $1 rise in. $2.7 million. Then 2.13 per $1 rise in sales. Per $1 rise in PBIT. Change the PBIT into 2.13. Okay. Is that correct? However, investment in asset of 2.7 million will be required in year 1. Then 2.13 per $1 increase in PBIT from year 2 to 4. We will calculate the change of PBIT. If PBIT is increasing by $1, your capex will increase by $2.13. $2.13 per $1 rise in PBIT. So what I have done, I have taken the change of PBIT, multiply into 2.13. Okay. For every $1 rise in PBIT, your capex will increase by $2.13. हाँ, you can minus 28.56 into 27.2, but वो sign positive आ जाएगा, बस that's it. Otherwise, this is okay. Capex sign is negative. I kept the capex sign negative. You can keep the capex sign positive. वो मसला नहीं, that is okay. Okay, it is expected that acquisition will create after-tax synergies worth 9.2 million per year in each of the first 2 years. You can separately discount these two. वो भी ठीक है, मसला नहीं है. Okay. First 4 years. You can separately solve this. Free cash flows. Discount rate is 11.92. You can also say that it is 12%. Okay, you can also solve the with 12%. Now, present value of first 4 years. Formula NPV, bracket start 12%, comma, select all cash flows. 63.58. Present value of cash flows from year 5 onwards. Take the last cash flow, 22.62, into 1.03 divided by 12% minus 3%, 258.94. Now multiply it with a discount factor of year 4 into 1.12 raised to power minus 4, 164.56. You can actually keep the discount rate simple because time is limited. Time is very short in the exam. So there is no need to solve with 11.92. Take the assumption. Present value of synergies. By the way, guys, you will receive 9.2 million every year for 4 years. So synergy per year is, you can solve it in the working. Solve it in the working. Solve the working little below. Synergy per year. 9.2. 4-year NVD factor. One minus 1.12 raised to power minus 4. So present value of synergy is 27.94. Okay. So total value. $256. But obviously, this is a business value because we have used the WACC. We need the equity value. By the way, equity is 70% of the total value, right? 179.2. So question is not to calculate the equity value. Question was, what is the additional value you have created? Additional value to the shareholder from Joshua proposed acquisition of Fraser. How much additional value you have created? Okay. Let me write the value of Joshua here. I have written somewhere. Now calculate the additional value. Remember, additional value is like synergy. Name is different. Additional value is like synergy. 21.262. So that's the answer. Okay. That's the answer of B part 2. Cannot take after 4 years in English. Synergy is only for 4 years. Now B part 3. Compare shareholder wealth before and after the acquisition by calculating the percentage change in equity value. And then next year dividend income for both companies. So let me write part B 3 index 3. Impact on shareholders wealth. Okay. Now you have to calculate the gain, percentage gain. What is increasing by 3%? Synergy is not increasing by 5%. Please read this again. It is expected that acquisition will create after-tax synergy worth 9.2 million per year in each of the first 4 years. From year 5 onwards, company free cash flows are expected to grow by 3%, not the synergies. Okay. Okay, let me calculate the impact on the shareholder wealth. So it's a share for share exchange. Joshua. And the other name is Fraser. Pre-acquisition value. Shares are not given. Market value per share are not given. But total share value is given. Don't worry about that. 102.56. So I'm just maximizing it for you people. Then post-acquisition information. Number of shares are not given. Total shareholder value is given. That is 179.26. Okay, you know only you only know this. Now what we are exchanging? We are exchanging three of our shares for against the one share of the company. Right? It is given, na? Okay, number of shares would also be given. Let me search the number of shares. Where it is given, if you can identify. One for three. 40 million and 10 million. 40 for Joshua and 10. Right? 40 and 10 million. Okay. Okay, now the acquisition is, we will transfer 3 share for 1 share of Fraser. Is it so? Offer is 1 Fraser share being exchanged for 3 Joshua share. So we will give 3 share against the 1 share. This will remain same. Please confirm, is it true? This is the case, right? Now calculate the market value per share. Okay, I have written here. Gain is post-acquisition value minus pre-acquisition. And now let me calculate the percentage gain. It's very nominal, I think. .43 and 37.19. Okay. So Fraser will receive 37.2% premium instead of 35%. Okay. It's free cash to the firm. Free cash to the firm. What was the other requirement? Compare shareholder wealth before and after the acquisition by calculating percentage and equity value and next year dividend income for both companies. We have to calculate the next year dividend income as well. Yes, please ask.
Yes, for calculation of the gain, so we ought to take always the market value of equity and not the market value of business, huh?
I didn't get you. Please speak louder.
So while calculating the gain, the post-acquisition value that we use was the market value of equity in the question. The 179.
Because it is given in the requirement that compare shareholder wealth before and after the acquisition by calculating the percentage change in equity value. That's why we are calculating the gain
Okay, but yes.
by comparing the post-acquisition value and the pre-acquisition value.
Okay, but there might be cases we might be using the total business value.
No, we cannot use the business value. Reason,
okay. Yes.
Always for shareholder, always market value of equity is relevant. It's never been the case that market value of business is relevant. Market value of business is only calculated just for the reference. And
okay,
from market value of business, we actually always calculate market value of equity. Okay.
Clear, thank you.
Sir, did you deduct market value of debt? Actually, I have calculated market value of business. Then I have taken 70% of that value because 30% is debt. Okay. Now let's calculate next year dividend income. Next year dividend. Okay, please tell me what is the dividend of this year? 2.7 million and 3.2 million. Okay. And it was written that how much company will pay? Fraser company founder and majority shareholder is unlikely to approve an acquisition offer on terms which would lead to a reduction in the annual dividend. However, Joshua company debt includes a covenant restricting dividend payment to 25% of each year free cash flow to the firm. So that means you have to pay 25% of the free cash flow as a dividend. So please tell me, if I take the year 1, what is the free cash flow of year 1? Let me search free cash flow of year 1. 19.6. And dividend will be 25%. $4.9 will be the dividend. And total number of shares. Now total shares are 70 million. Remember, total shares 70 million. So how much Joshua company will get the dividend? First of all, calculate the per share dividend. Per share dividend is 4.9 million divided by 70 million, 0.07. This is million. This is dollar million. So now Joshua company dividend. Fraser dividend. Joshua shares are 40 million. Their dividend will be 2.8 million. Fraser shares will be 30 million. And their dividend will be 2.1 million. And that is below. That is the next year dividend. What is the old dividend, by the way? You can also write that. Old dividend was 2.7 and 3.2. 2.7 and 3.2. So who is in problem? Please tell me. Joshua or Fraser? Who will mind about the difference? No, Joshua previous dividend is 2.7. Now they will get 2.8. It's a Fraser, na? Previously they were getting 3.2. Now they will get 2.1. चाहिए? Okay, we have done part 1 to 3 of B. Now we have to make a report. In the report, we have to advise the board of any concern either company shareholder may have with the acquisition and discuss the validity of the assumption made in proposal 1, 2, and 3. And discuss the credibility of the CEO alternative approach to use a shares buyback as a takeover defense. Advise whether or not this is a feasible strategy. So let's discuss this fourth part. Advise the board of any concern that either company shareholder may have with the acquisition. So let me read the scenario with you people again so that we have some effective discussion. So please focus and let me quickly read the question again. Joshua funding option have deteriorated significantly since last year. Cash offer for Fraser company was rejected. Previous year, you had given the cash offer to the Fraser company and Fraser company rejected it. And now you do not have any cash. It no longer has the cash reserve required to fund another cash offer and the shareholders are unlikely to agree to a right issue so soon after the last attempt, which also ended in failure. In addition, Joshua company gearing significantly exceeds the industry average and the company is close to breaching one of its bank covenant. So you cannot take more loan as well. CEO has therefore suggested a new offer is made for Fraser company based on share for share exchange. Okay, that's the information. Post at cost of capital, we have done that. Post acquisition cash flow, we have done that. Okay, share for share exchange. CEO proposal for a share for share exchange will involve one Fraser company share being exchanged for 3 Joshua company share. Based on, this is important now. Based on last year negotiation, the board believes it has a good understanding of the Fraser expectation. You have therefore been asked to incorporate a minimum acquisition premium of 35 in your analysis, which is the same premium which was requested last. Guys, Fraser, in last year, Fraser had requested 35% premium. And you propose the cash offer and they rejected the cash offer. Now you are offering share for share and now you are giving 37% premium to that party. Will they agree? No. Maybe. But share for share exchange is subjective, na? Share for share exchange is, it includes the uncertain value. So we have to discuss that. Fraser company founder and majority shareholder is unlikely to approve an acquisition offer on terms which would lead to reduction in the annual dividend. By the way, annual dividend is reducing. However, Joshua company debt includes a covenant restricting dividend payment to 25%. The board has therefore also asked for an evaluation of the impact of the proposed term on the next year forecast post-acquisition dividend for both companies. So there are some positive values, there are some negative points that what we have to discuss. So let's discuss. Let's make the report. So please have a focus. I am making a report here. Part B. Report to the board of directors of Joshua company. Okay. Highlight this. So start with the introduction. You can also write the subject, but there is no need to give the subject here because examiner normally do not write the subject. So why we should add it? So there is no need to do that. So start with the introduction. This report covers the proposal to acquire Fraser company by estimating combined WACC, additional equity value, impact on wealth of shareholders, including next year dividend. Okay. This report also covers the assumptions that has been taken in calculation of WACC and additional value in appendix 1 and 2. 1, 2 and 3 actually. So that's the introduction. Okay, that's the introduction. Now you will write one by one. Now you will write all the points one by one. So let me read the requirement. Advise the board of any concern that either company shareholders may have, and then validity of assumptions, and then conclusion. So we will discuss the concerns of shareholders. Give the heading shareholders concerns. Now write it. There would be many concerns of the shareholders, especially Fraser. Right? So what we should write, guys? In last attempt, Joshua failed to acquire Fraser company as it failed to create any value. In revised offer, Joshua is creating additional value and offering 37.2% premium to Fraser Company more than required 35% premium. Yes, we have to write that appendix 3. This is the proper way. Both shareholders have concern, may have concerns over these calculations of additional value. So Joshua management should communicate that what has changed from last offer to this offer, that now it is creating value. Okay, you have to explain this. It is evident that 37% gain is transferred to Fraser Company, and only fractional gain or marginal gain is to Joshua shareholders. It is unlikely that Joshua shareholder will accept this proposal because they are not getting the value, right? Because if you see it, what is the gain to the Joshua company? 0.43%. So why they will bother for this acquisition for the 0.43%? Right? Next. Last offer was cash offer, and it was rejected by Fraser Company. Although new offer is creating 37.2% gain, but it may be rejected again by Fraser shareholders as share for share exchange always have uncertainties, right? Based on this reason. right? However, out of 70 million shares, Fraser has now 30 million shares. This is this lead to significant control over the group. Obviously, they are getting the significant shareholding. Na? Out of 70, they are getting the 30 million, more than 40%, right? That's the positive point. Then you write another concern of Fraser is, what is the another concern? Next year dividend. They declared that they will not accept the offer if next year dividend decreases. In our calculation, dividends are decreasing mainly because of covenant imposed by lenders, right? Covenant imposed by the lenders. Joshua should communicate this issue to Fraser, that after few years or after this loan period, dividend payments may increase. You can also write this. Fraser may accept this offer. Why Fraser should accept, guys? Write some positive points. Why Fraser should accept? Do you have any positive point? Fraser may accept this offer because of 37% gain, board of director representation, and significant shareholder. Still, it all depends the detail of previous rejected offer. That's why previous offer has been rejected. Because if we have the detail of the previous, we can improve the current offer by negotiating with the Fraser. Okay, now you have to write the assumptions. Now you will write the assumptions. Let's write few assumption as well, guys. Anyone? It is assume that all inputs used to estimate combined WACC and market value are accurate and reasonable. It is assumed that combined capital structure will stay the same as the existing capital structure, which may not the case in actual, as market value of equity may change on the reaction of shareholders after merger announcement. Okay. Anything else? Credit spread will increase by 4.1%.
हाँ क्लास चल रही है मैं बस फोन करके आ रहा हूँ मुझे नहीं पता
Credit spread will increase by 4% after merger. No detailed information is given about the pre-acquisition debt and how spread has changed to 4.1% after acquisition. By the way, I'm not appearing in the exam. You people are appearing in the exam. So please tell me that what more assumption I can write. Acquisition will create after tax synergy worth 9.2 million per year. No information available. It is assumed that its synergy of $9.2 million will be created in only 4 years. No information is given after 4 years, right? It is assumed that free cash flows will increase by 3% till perpetuity. No basis of information is given to justify this, right? Capital structure will remain constant. You can also write that. Any other? CAPM assumption. capex will change by $2.13 against $1 rise in PBIT. That is highly subjective. It can change in future depending on the economy and company needs. Then you can write about the tax and interest rates. There are many assumptions which you can write. It is assumed to ignore the merger and acquisition cost. Which may not be the case in reality. In reality, there must be some cost. You can also write about the difference that covenant is given. I think write the dividend in the shareholder concern, not in the assumptions. Okay, then you will write. So I'm assuming you can write more here. Then you will write shares buyback. Then you will write recommendation. And then you will write the conclusion. Okay, then you will write report by and date. There is no need to write your name here. There is no need to write the date here. Okay, can anyone tell me what you will write in the shares buyback? What you will write in shares buyback? One of the director has suggested to buy back the shares. Okay, let me explain. Let me explain. Listen carefully. In shares buyback, you will firstly write what is share buyback. You will write that one of the director has suggested to implement the share buyback scheme as a defense strategy. In shares buyback, company will buy its voice is clear, guys. Are you listening? Okay, let me explain the shares buyback. Listen, the shares buyback here. You will firstly write that one of the directors has suggested that company should use the shares buyback scheme as a defense strategy. If the company do the shares buyback, I'm telling you the plus side. If the company do the shares buyback, what will happen? It will when you start buying the share, when you start buying your own shares, market value per share will increase. Why? When you start buying your own share, the demand will created and the market value of the shares will start increasing. Plus, when number of shares are lower in number, EPS will start increasing. Right? EPS will start increasing. So it may give the positive signal to the market that this company is buying its own shares. This company is investing in its own shares. And the EPS is also rising. But now, write the negative side. How can you buy the shares? You were in liquidity problem. You do not have cash. How can you buy your own shares? So if you start buying your own shares, you need money. And there is no money obviously available. So from where you will get the share? From where you will get the money? From the banks. And banks are not ready to lend you. And plus, if you able to borrow more, debt covenants are about to breach. Plus, even if you have cash, let's assume even if you have cash, let's assume, although it is not available, let's assume even if you have cash, when you start buying your own shares, gearing will, equity will decrease, gearing will, guys, gearing will increase. And when gearing will increase, what will happen? You are about to breach the covenant. Bank will demand the money. And your system can collapse. Okay. So you have to write the negative and plus side of this. Right? Then why guys, why still you can recommend the buyback? The only benefit of buyback is it can create the deterrence. People may stop buying your company. Otherwise, it can have a disaster effect. Right? Okay, then you will give the recommendation and the last step is conclusion. That's how you will write the answer. Question numerical part was very easy by the only thing which will create a difference between pass and fail is a discussion of the theory. Right? So by the way, any one of you have submitted the assignment? And by the way, we didn't have discussed the part A. What is the part A, by the way? Discuss the agency problems created by Joshua proposed takeover of Fraser Company as a defense and risk diversification strategy and explain how these could be mitigated. So let me read the first exhibit again for the A part. It will take few minutes. Please be with me. Joshua Company is a listed leading fashion retailer with store base in flagship retail center nationwide. For many years, Joshua has been highly popular, but its financial performance has suffered recently due to the problem associated with its online operation. These problems are causing concern for the company's institutional shareholders. Online rivals have emerged in recent years and quickly reducing Joshua market share. These companies have also successfully diversified into other areas such as household furnishing once they have established a well-known brand. Joshua recently attempted to acquire one of these online rivals, Fraser Company, but neither company shareholder approved the deal on the ground that it was unlikely to create value. So shareholders are not ready for this acquisition. Okay. Following a series of profit warning, there has been ongoing media speculation that Joshua Company is attracting takeover interest. There has been no approach made so far, but Joshua, director, are concerned about the implication for their future in the company. This line is very, very important. This is your answer, guys. This is the line which you need to focus. Joshua chairman would like to discuss defense strategy at an upcoming board meeting, particularly the suggestion that Joshua company could defend itself against a takeover by improving its own takeover offer by Fraser. The rationale for this suggestion is that it would be much more difficult to acquire a large Joshua company. In addition, this would also introduce a risk diversification benefit. So read it again, please. So now the discussion is interesting. What is the agency problem here? Can you identify? Let me explain. Guys. You are the shareholders. You all are the shareholders, and I'm the director of the company. Can you imagine the perks and benefits of directors? The perks and benefits of directors are huge. They are very high in numbers. Like, let me tell you one thing. Let me talk about my institute. I work in one of the largest and one of the most profitable bank of Pakistan. My CEO salary is 450 million rupees annual salary. 450 million rupees. Ignore the dollar, ignore the currency devaluation. Just think according to the country. 450 million is a huge amount. So if I'm the director of the company earning 450 million rupees, and suddenly if I face a job loss situation, I will do everything to save my job. Because 450 million is a huge amount. What do you say? Many of you are doing the job, right? And we are doing the job at like normal salary level. But if you are the director of the company, if you are the chairman of the company and you are earning in millions of rupees and dollars, and suddenly you are facing the job loss, what you will do? You will do everything to save the job, right? Kya khayal hai? Agreed? So, what will happen here? Give me a minute, guys. So what will happen here? There is a takeover situation and there is a merger situation. What is the best position? What I can do? I should consult the shareholders. I should tell the actual situation to the shareholders and let the shareholder decide about the future of the company. But I'm not doing that. I am saving my own future. That is agency problem. So first of all, you will explain that what is agency problem. You will write that there is a conflict between shareholders and the director of the company. Director will prioritize its own interest over the interest of the shareholders. So at that moment, agency issue will arise. So here in this case, the board of directors of Joshua company are suggesting to acquire the Fraser company to avoid the takeover as a takeover defense. Even Fraser is not relevant. Still, you are acquiring the other company to save your own job. And plus, you are also acquiring the Fraser company to risk diversification. acquiring fresher company is the diversification benefit for the shareholder, for the director. Director job portfolio is diversifying. It's not the benefit to the shareholders because majority shareholders are institutional shareholders. Institutional shareholders are already diversified. So there is a conflict of interest. So you have to explain it. You have to fully explain it. Guys, are you getting the point, right? What is the problem here? So there are two conflicts of interest here. First, you are keen to acquire the fresher company just to save your own job, because if you acquire the fresher company, company will become larger and nobody will acquire you. And it is evident from the calculation that only 0.4% gain for the Joshua shareholder. Majority gain is being transferred to the fresher company. Second, risk diversification is also source of conflict. You are diversifying your own job portfolio. You are not diversifying the company interest. So how to mitigate this? The board first need to take the approval from the shareholders. The board itself cannot decide the future of the company. The board has to take the approval, has to convince the shareholder before doing any adventure, before doing any decision. Okay. And especially last time Fraser had rejected the offer. Now what you are offering again, that they will accept the offer. You also need to take the approval from the shareholders. That is what you will discuss in part. I think this has been now cleared. So let me if there is any assignment. Okay, I have received few assignments. If it is only numerical, then obviously there will be no use. Give me a minute, guys. Why I am unable to see the give me a minute, please. Okay, we have a first question. Combined WACC, market of equity, Fraser, weighted average, beta is correct, WACC is correct. Free cash flow, market of equity, capex. Why you have deducted the interest? There is no need to deduct the interest. It's a free cash flow to firm mode. You're using WACC and deducting the interest. This is wrong. Okay, synergy. Synergy will not be calculated after year 4. Synergy will only be for first 4 years. Okay, gain. Okay, that's why gain is 129%. It's not dividend valuation. You only have to predict the next year dividend. You only have to predict the next year dividend. Okay. Part A, I'm leaving the part A. Part B. Where is report, by the way? Where is report? You have not made the report. Report is necessary, yaar. Report to banao kam se kam. That's a put on bad plans. How this is Pac-Man defense? Fraser was requiring the Joshua. Joshua was requiring the Fraser. It's not a Pac-Man defense. The issue normally arises when a small company bids for a very large company. Your all focus is on the Pac-Man in agency problem as well. Only this is relevant, board neutrality. Okay, this is correct. Assumptions are, by the way, correct one. This is a defensive strategy which is designed to make target company unattractive by entering into arrangement to sell and lease back share. Sale and buy back shares. Okay, this is right. You have written on the crown jewel as well. Okay. Okay, you can improve this. You can seriously, you can improve this. This is not that up to the mark, to be honest. You can improve that. Okay, next assignment. Let me open the numerical first. Okay. By the way, back is, I think everybody has done the back correctly. Excellent. 179 million is okay. Oh, mashallah, excellent. 0.4. Okay. This student has even calculated the percentage change. Excellent, excellent. That is good. Where is the report? Agency problem arises when there is a conflict of interest between the agent, which is in the case our board of directors and principal. It is a directed job to maximize shareholder wealth. However, the intention behind the proposed takeover of Fraser Company seems to be self-divulging, as Joshua Company directors are concerned about the implications thereof. Excellent. The rationale is that this will reduce the risk aversion benefit in the Joshua Company operation. While this is a valid step, it is not applied. Okay. It also says that this would serve as a defense regime seems to be accurate. Seems to be no conflict of interest here as only. Okay. A part is good, but I think you haven't done the B part. All the numerical is great, but obviously you need to make a report in order to get the marks. Okay. The key to success is write the answer carefully. There is no rocket science involved, to be honest. Seriously, it is not that difficult. No rocket science involved. You only have to solve the question carefully. Okay, beta asset is good, beta equity is good. Back is 12%, A part is good. Almost, you have done almost correct. Okay. There is some slight difference. Otherwise, it is good. Percentage acquisition 3.3. Because of that slight change, here gain has been different. But it is overall numerical is good. You will almost get full marks on the numerical. Whoever has done this. It is a role of director to maximize the wealth of shareholder. There is an agency problem if the directors are not maximize wealth, but only cater for their own interest. Okay. Whenever guys, whenever you are writing or addressing some problem, like here we are going to discuss the agency problem. So first discuss what is agency. And then discuss what should be the case. You have to explain that what is agency and explain that it is the director duty to maximize the wealth of shareholders. Okay. By the way, it is good. In Joshua case, shareholders are concerned about the profit of the firm. They have already might be concerned about the future investment review for directors to put their auditors. They are considering the fresher offer based towards any. Okay, this is okay. Answer is okay, but I will suggest that you can write more here, more convincing point. But by the way, it is okay. Report to the board of directors of Joshua Company. Write the name of the company as well. Please. Introduction. Do highlight this. It is good. Examiner will not deduct marks for this. This is right. But do highlight this. This report calculates the post-acquisition weighted average cost of capital for the combined company. It also estimates the additional value shareholder. In addition, it compares the maximum shareholder wealth. Excellent, excellent. Post-acquisition. Do not number it. Appendix shows the post-acquisition value. Okay. Okay. Board concern. Okay. That's a good point, by the way. This one. Assumption. Tradability of shares buyback. And excellent. Compiled by date. This is a good answer. You will, by the way, guys, everyone, please look at the report. It's a request, don't do the numbering. But if, and always highlight the heading. These are my suggestions. Guys, based on this report, this candidate will get full marks on the communication. And out of 10, there are 5 marks for communication. Based on the structure of the report, by proper labeling the headings, by giving proper headings, and by giving the conclusion, by making the introduction, by giving the headings, this guy, this student, this candidate will get 5 marks, 5 professional marks for communication. 5 professional marks for communication. I'm not talking about these 5 or 11 marks. I'm talking about these professional marks. 4 professional skill will be tested in this part. 4. 5 marks is only for the structure of the report. And remaining 5 marks for evaluation, skepticism, and commercial acumen. And look at the answer. Look at the answer. This person has clearly explained the shares buyback, assumptions, board concern, and this person also explained the numerics of the question. So this person will also get few marks on the analysis and skepticism and acumen. So in my suggestion, this person will get full 10 marks for the professional skills. Yes, examiner is too lenient while distributing the marks. Don't worry. It is us who are not getting the marks. Examiner is lenient. Why I'm saying this? Let me explain you. Guys, I participated in one of the activity conducted by our examiner. What was that activity? Listen carefully. Examiner has given us two papers of the candidate, 2 actual papers of the candidate, and examiner asked us. By the way, this exercise was conducted for many institutes, tutors. So examiner has asked us to mark those 2 papers. And seriously, I was under the impression, it was like 3 or 4 years ago, I was under the impression that I have to mark it strictly. And I marked it very strictly. And then examiner conducted an exercise. In that exercise, examiner guided us that here you can give more marks, here you can give more marks. And especially if you're doing something wrong in the numerical, you can deduct the mark. But on the wrong numerical, if the student has done some discussion, you cannot deduct marks in the discussion. You have to give marks even the discussion is on the wrong calculation. That's the beauty of our paper, ACCA and examiner. So why you are worrying? Examiner is too lenient, believe me. Okay? Any question? Or are you getting benefit of this session? Motivation मिल रही है? Are you getting any motivation? Obviously, I'm consuming energy. So it should be beneficial for you. Okay, perfect. So tomorrow we will solve question on the risk management. So I have to identify same time. It's same time 7:30. I have to identify a question and I will share in the group. ठीक है, रिस्क मैनेजमेंट क्वेश्चन।